Ladies and gentlemen, welcome back to Driven Wild. Today we are talking about income tax brackets. So there's a lot of misconceptions about how income tax brackets work and has even led to some, let's say, unsettling arguments to why someone wouldn't want to make more money. Some of the things I heard are just wrong on too many levels, but nevertheless, we have to bust those myths wide open before someone else gets fooled into it. So with that said, we are talking about everything you must know about income tax brackets, what people have been told from various parties versus how it actually is, and everything in between. But before we do that, let's go over a quick disclaimer. The content of this video does not contain and is never intended to be legal, business, financial, tax, or health advice of any kind. This video is for entertainment purposes only. It is advised that you conduct your own research and consult qualified professionals before applying anything you find online. Also, thank you to GigTax for verifying this information and making this video possible. How your tax filing status affects your tax brackets. So there's actually 4 statuses in which you could file your taxes in terms of your personal income taxes. Single, married and filing jointly, or the qualifying widow status, they fall into the same category. Married and filing separately, and head of household. Each of these statuses have their own nuances, benefits, and disadvantages that come with each status and are applied to each person on a case-by-case basis. The details of that go into much deeper detail than we can cover in this video, so I will leave a link in the description about tax filing statuses. Feel free to check that out. How the tax brackets actually work. So the US has a progressive tax system, and broadly that means the government decides how much you owe by dividing your taxable income into chunks, also known as tax brackets. Each chunk gets taxed at a corresponding rate, the highest rate being the marginal tax rate, applying to only a portion of your income. The progressive tax system also means that people with higher taxable incomes are subject to higher federal income taxes, and people with lower taxable incomes are subject to lower federal income tax rates. The beauty of the tax brackets is that no matter which bracket you're in, you won't pay that tax rate on your entire income. This is also why in a lot of cases companies like to write off as much as possible and maximize their deductions. So on paper, it doesn't look like they made any money or very little money. Hence why DoorDash and Uber can get away with as much as they can, huh? And for us gig workers, we make some real revenue in a lot of cases, but after our business expenses, our profit doesn't look all that high in terms of taxable income. But we'll go into that in a bit. I am doing you a favor. This is probably one of the most frustrating phrases for me as a person, because you know that you're saying this to one of 3 people. A crappy manager looking to avoid giving raises for some reason, somebody who was told by some crappy manager looking to avoid giving raises, or somebody who heard that through the grapevine and really didn't do their research and took it at face value. So if you hear this from a crappy manager or somebody who is paying you and they don't give you a raise for whatever reason, you better be job hunting, because he's taking advantage of you and your good nature, or really your lack of understanding of how taxes work. 2024 is the year you take control of your financial future and don't let crappy managers pull this crap. State income taxes. I probably should have said this earlier, but everything is going to be market dependent and state by state and city by city in a lot of cases. And what applies to me may not apply to you. States may handle taxes differently than the federal government, and your state might have different tax brackets altogether, or it might use an altogether different system. For example, Colorado has a flat tax rate of 4.4% on taxable income, period. And some states, such as Wyoming, Florida, Tennessee, they don't have state income taxes. In fact, there are 8 states with no income tax at all, and New Hampshire, where they only have taxes on dividend and interest income. So make sure you do your research and what applies to your state, your city, wherever you are, and what taxes you are obligated to pay. Inflation versus tax brackets. Each year, all the income tax brackets, the window of income where the tax rate ends and begins, are updated to reflect the current rate of inflation, and tweaks, formerly known as inflation adjustments, are a critical part of the tax code. This can help prevent taxpayers from ending up in a higher tax bracket as their cost of living rises, a scenario called the bracket creep. Tax bracket adjustments can also lower taxes for those whose compensation has not kept up with inflation, ergo the large majority of the US. Let's go over an example. In 2023, a single filer making $45,000 of taxable income will pay a 10% tax rate on the first $11,000 of their earnings, a 12% rate on the portion of earnings between $11,001 and $44,725, and a 22% tax rate on the remaining $275 that fall into that final tax bracket. And for the record, that would make the marginal tax rate 22%, even though it only encompasses about $275. But we'll go over the marginal versus effective tax rate in a hot second. Assuming this taxpayer's income does not change in 2024, they will now pay a 10% on earnings up to $11,600 and 12% on the rest. In other words, they will no longer pay 22% on any part of their income. That's because the upper end of the 12% tax bracket has been updated from $44,725 to $47,150, which allows this taxpayer to shelter more of their income from a higher tax rate. Which, for the record, if you're not trying to grow your income, what are you doing? But that's a different conversation for a different video. But that's also why it's important to check with the IRS website each year to make sure you're paying exactly what you owe in taxes based on the brackets of that year. I'm going to leave a link in the description of the federal income tax rates and brackets from the IRS website. Feel free to check that out. Marginal versus effective tax rate. The marginal tax rate is the tax rate paid on the last dollar of taxable income. Typically, this equates to the highest tax bracket. If you had $45,000 of taxable income, most of your income would fall within the 12% tax bracket, right? However, like we said earlier, the highest rate in 2023 for $45,000 was the 22% because of that $275 was in the final tax bracket of the taxable income you were receiving. The effective tax rate, however, is the overall percentage of income for an individual or corporation pays in taxes. The effective tax rate for individuals is the average rate in which their earned income, such as wages, or unearned income, such as stocks, dividends, and otherwise, is taxed. The effective tax rate for a corporation is the average rate in which its pre-tax profits are taxed. And keep in mind, it's pre-tax profits, so you still have opportunities to write off, but once you're done with that, this is how much profits you earned that have not been taxed yet. Taking the same example of $45,000 of taxable income, in 2024, the effective tax rate would be 8.09%. By the way, this was a fun little calculator I found online. If you want to check that out, I'll leave the link in the description. Reducing your taxes owed. I touched on this earlier, but there's a huge difference between revenue and profit, and your taxable income isn't simply based on revenue, it is based on profit. I had a commenter earlier say that they paid $10,000 on $45,000 of income, which there's just worlds of wrong with that, and I'm sure it was just a hate commenter hate commenting. But it shows how people who have no idea how taxes work will say anything, and people will inevitably misunderstand it. Now, there's a huge number of ways to reduce your taxable income, especially for gig workers. You have your classic tax credits, dependents, and deductions. You have the business side of things with writing off your business expenses, and not to mention the HSA, IRA, and 401ks, and many, many more. Of course, if you want to make sure you don't want to get into trouble and only write off what you actually qualify for and not push any of the boundaries where you shouldn't be pushing. And one of the best ways to ensure that you're doing just that is to work with a tax professional, and that's where GigTax is here to help. Filing your taxes on time, promptly, and accurately is an inevitable aspect of being in business for yourself, and GigTax is here to help you. For every hour spent navigating tax season alone, you miss out on potential earnings, precious moments with loved ones, and expose yourself to financial risks. Recognized as the leading tax preparation service for gig workers, GigTax is dedicated to simplifying the process, saving you time, energy, and money. Founded by Joseph Mayo, a seasoned gig worker with 6,000 deliveries across 6 platforms since 2020, GigTax addresses the overlooked, overcharged, and underserved needs of gig workers in the financial realm. Driven Wyld subscribers can take advantage of an exclusive 77% discount on GigTax's tax prep, bringing the price from $538 to $124. Act now to get this price locked in before GigTax's calendar is booked, because GigTax helps people just like you make the wisest and most effective decisions on your business and personal taxes all year round. Secure your spot today with GigTax using the description link below to the Instagram page of GigTax, and direct message him Wyld and book an appointment with him so that way you can maximize your savings and get back to what you do best, making the most amount of money in the least amount of time in the safest possible way. Thank you so much for watching. I really appreciate it. As always, make sure to hit the like button, subscribe if you're new, and I'll see you guys next time. Peace.